Welcome to this Nedbank Financial Market Educational Series, proudly brought to you by our online share trading division. Learning about trading and investing is essential for every client, as this will equip you to make more informed personal trading and investing decisions. In this educational video, we will discuss tax-free savings accounts, or TFSAs. Please note that this session is on a beginner and intermediate level. Please refer to our disclaimer. In summary, you cannot regard this session as any trading or investment advice, as it has been provided for educational purposes only. Let's commence this session. Let's start by defining what is meant by a tax-free savings account. TFSAs were introduced by the South African government in 2015 as an incentive to encourage household savings. They provide tax benefits to investors, as all the growth and income received on the investment is tax-free. This means that you are not liable for any capital gains tax, dividends withholding tax, or tax on the interest received. Although commonly referred to as savings accounts, they can include a number of investment vehicles. Contributions towards your TFSAs are made with post-tax money, meaning that unlike retirement fund contributions, no income tax deduction is available on your contributions to a TFSA. It may therefore be prudent for an investor to first ensure that they are contributing adequately to a retirement fund to minimize their taxable income before taking out a TFSA. TFSAs can be utilized as tax-efficient investments towards your retirement or long-term savings goal. You need to think of a TFSA as a long-term investment. The tax benefits achieved by investing in a TFSA multiply over time, which means that TFSAs do not make good emergency funds accounts. It is recommended that investors take a long-term view when setting up a tax-free savings account. The value of the tax benefit in the first 5 years is small, and the investment return and tax saving only become significant after about 10 years. Although TFSAs are not necessarily intended as retirement funding vehicles, they are often used to supplement retirement savings. They are a very effective vehicle to build your investment funds over the long term. They can help create a retirement nest egg, as the tax savings generated are incorporated into the investment. Frequent withdrawals from your tax-free investment would minimize the long-term returns that could be earned. Investments into tax-free savings accounts have certain limits which are governed by legislation and may change. As an individual, legislation allows you to invest up to 36,000 Rand per year towards a TFSA, or 3,000 Rand per month, with the maximum lifetime contribution of 500,000 Rand. Most product providers make allowance for a minimum monthly contribution with the option of making monthly or annual contributions, or even ad hoc contributions as and when the opportunity arises. Depending on the nature of your earnings, you can set up a debit order or payment system into your TFSA that works for you. For instance, if you are a commission earner, you may want to contribute a smaller monthly amount via debit order with the option of making ad hoc contributions as and when your cash flow allows. No matter what payment frequency you choose, your contributions need to remain within the annual and lifetime thresholds. Should you exceed these limits, you will be penalized 40% on contributions above the limits by the South African Revenue Service, or SARS. It is the investor's responsibility to monitor and ensure they do not contribute more than the prescribed limits. Any person can have more than one tax-free investment with more than one service provider. Remember, however, that the annual and lifetime thresholds are applied at an individual level across all service providers and accounts. Before we proceed, let's highlight who is authorized to offer TFSAs to the public. The tax-free investments may only be provided by a licensed services provider, such as a bank, long-term insurers, a manager of registered collective schemes, with certain exceptions, the national government through a mutual bank or a cooperative bank, the South African Post Bank, an administrative financial services provider, and a person authorized by a licensed exchange to perform one or more securities services in terms of the exchange rules as designated by the minister in the Government Gazette. Always ensure that the entity you are dealing with is authorized to offer the product. When choosing a TFSA provider, South Africans are spoiled for choice. Most reputable investment platforms offer a wide variety of local and offshore funds to choose from, meaning that you can construct a portfolio that meets your specific investment goals. While you do have the option of investing in a money market or fixed-term bank account, it is likely that your TFSA will achieve more favorable returns over the long term if housed in a more aggressive unit trust portfolio. Importantly, consider choosing an investment platform that can provide a holistic overview of all your investments, including your retirement annuities and discretionary investments. Let's review the type of investments that qualify as tax-free investments. Fixed deposits, unit trusts, and more specifically collective investment schemes, retail savings bonds, certain endowment policies issued by long-term insurers, linked investment products, and exchange-traded funds, or ETFs, that are classified as collective investment schemes. It is always best to approach your financial services provider for the list of available tax-free accounts they offer. It is also advisable to consult with a financial planner or wealth manager before making your choice across the range of service providers and instruments available. Legislation permits you to withdraw from your TFSA at any time, but it is important to first understand the implications of doing so. Any withdrawal made from your TFSA is deducted from your annual and lifetime thresholds. If you have already reached the annual threshold, you will not be allowed to reinvest any withdrawals back into a TFSA for that financial year. Every time you contribute, your lifetime threshold is reduced. This figure is not adjusted when you withdraw. For instance, if you have contributed a total of 300,000 Rand towards your TFSA and you withdraw 50,000 Rand, you will still only be able to contribute another 200,000 Rand during your lifetime threshold of 500,000 Rand. In other words, although you can top up your TFSA again after a withdrawal, any withdrawal will result in you forfeiting your tax benefits on the withdrawn amount, while at the same time using up part of your lifetime contribution, which will result in you losing out on potential investment returns. Depending on the product and service provider, there may be withdrawal limits applied if the investor would like to retain the product. It's important to align your investment portfolio with your investment time horizon. When setting up your TFSA, give careful thought to how you intend to use the proceeds in the future, and then choose an investment portfolio that is aligned with your timeline. For instance, you may wish to use it as a savings vehicle for your newborn child's tertiary education, in which case your investment time horizon is approximately 18 years. On the other hand, if you want to use it to supplement your retirement funding, you may be looking at a longer time period. Either way, if you've taken a long-term view of your TFSA, consider having a higher allocation to growth assets and less allocation to cash and fixed income, which are poor long-term investments. Your TFSA will really start working in your favor if you target the growth asset classes where the underlying assets pay dividends or trigger capital gains tax, which your TFSA investment is exempted from. What should you be aware of when setting up a TFSA in your child's name? TFSAs are a long-term investment. The longer the investment time frame, the more tax benefits accrue. It can therefore be a great investment to take out in the name of a minor child. However, there are some important things to bear in mind. Be clear on what the intended purpose of the investment is. Are you saving for their education, deposit on their first house, or their retirement? And ensure you choose an appropriate investment instrument or fund that will help you achieve the required goal. You may exhaust your child's lifetime contribution threshold on their behalf. As the investment is in the child's name, you'll be using all or part of your child's lifetime allowance, so you need to keep careful track of how much is being contributed. Note that your child will have transactional rights when they turn 18, so it is important to educate them on the contribution thresholds and negative consequences of early withdrawals. Legislation requires that any withdrawals made from a minor's TFSA account must be paid into the minor's bank account. Once the lifetime threshold of R500,000 is reached, no further contributions can be made. However, the investment will continue to grow at an accelerated rate. As no taxes will be levied against the investment, your child's investment will benefit from compound interest over an extended period of time. If you wish to transfer your TFSA from one provider to another, keep in mind that such a transfer can only be made between licensed service providers. Units can be transferred between licensed service providers without a withdrawal. If the transfer is processed via a withdrawal, the reinvestment of the withdrawn amount would count against the annual and lifetime prescribed contribution limits. Check with both the current and receiving service providers for the appropriate mechanism to facilitate the transfer without impacting your contribution limits. Depending on the rules of the product, transfer can be done partially or the full investment. An important element with any of your investments is to keep your records up to date with the South African Revenue Services. Even though no tax is payable on the earnings within a TFSA, as a South African tax resident, you are required to disclose all investment information to SARS when submitting your annual tax return, including certificates issued for income within your TFSA. Financial service providers will provide SARS twice a year with the following info: total contributions per tax year, total amounts withdrawn per tax year, total amounts transferred per tax year, total returns on investment, for example, interest, dividends, capital losses, and capital gains. The service providers will also provide taxpayers with this information by issuing an IT3S tax-free investment certificate annually. In conclusion, there are a large number of tax-free investments available to investors, making it easy to find an investment that suits your long-term investment strategy. A TFSA is exactly what it sounds like. You do not pay tax on interest, dividends, or capital gains on the investment. It is therefore a way to grow your money without getting taxed on the growth. These savings accelerate the growth of your investment over the long term. Investment returns do not count towards your contribution limits. There are no penalties for withdrawals. In summary, a TFSA investment is a very attractive vehicle to have in your long-term investment portfolio. The sooner you start saving, the better. We have come to the end of this video. This educational session was brought to you by Nedbank Online Share Trading. Any examples used in this session are purely for illustrative purposes. Thank you for your time.